Yeah, I mean, I think this is probably one of the most positive trends that we're seeing for the U.S. You have several different impacts of this. So first of all, the main driver here of the positive trend is the innovation in technology to actually get gas out of shale deposits. So the fracking, so-called, or the horizontal fracking, is something that has helped to unleash the gas and even oil out of these deposits. So technology innovation leading to much higher production of oil and gas. If you look, for example, at oil production in the U.S. over the last 3 has been accelerating very, very quickly. In 2011, it was growing around 4%. And natural gas exploration and production actually has risen quite visibly as well, and has been growing at around 4 to 8% over the last 6 years, every year. So that boom has already started. You have different effects. So some of the most important effects is that you have an energy import substitution. The U.S. still, one of the biggest reasons why the U.S. has a current account deficit is the importation or imports of oil. The other reason is imports of consumer goods. So imports of oil, if you assume that you look at the import bill relative to GDP right now is around 2%, if you assume that this would close over 10 years, so that the U.S. would almost be energy independent in 10 years, then this would add 2% growth, 0.2% growth to GDP every year over 10 years. The other positive impact is that you will generate more infrastructure spending for these industries, and you'll also employ more people for these industries. Now, these industries are fairly small relative to GDP, so even with growth rates of 10 to 20% every year, it will be a very minor impact on overall GDP just because they're very small relative to the whole pie. So that's probably a negligible impact on GDP growth. The other very positive impact, though, is the positive spillovers to non-energy related sectors. So for example, the chemical industry is very heavily dependent on energy input to produce their products. They consume about 30% of energy consumption of all the industries in the US. So looking at the impact of lower gas prices, substitution from oil as an energy input to gas as an input, or electricity as an input, would add, for all the industries outside of the energy sector, would add another 0.5% to growth over a span of about 5 years. Now, the flip side of the coin is that if you have less dependence on oil imports and your trade deficit narrows, then typically the dollar would appreciate in that environment. Clearly, one of the reasons why the dollar has been weaker over the decades has been because of the current account deficit. The current account deficit has already closed quite a bit, from about 6.2% in 2005 to about 3% currently. But if it would close further, say to about 1%, then there's going to be an upward pressure on the value of the dollar. So that would be probably an impact on net exports, which again would curtail GDP growth by about 0.3 percentage points. So if you add all these numbers together, we think that the boost to GDP over the next 5 years of the shale gas industry is probably going to be around 0.5 percentage points of additional growth over the next 5 years every year. Now, just as a matter of comparison, there's been an economist that calculated the impact of the tech boom in the 90s on GDP, and they concluded that the impact was about 1.6 percentage points more growth per year over 5 years from 1995 to 2000. So as a matter of comparison, the shale gas boom is probably not going to be as strong of an impact as the tech boom, but it's still sizable.